All right, let's kick things off. So we're going to talk about the new money layer, which I think most of the people in this room would argue is stablecoins. But before I kick things off, really quick show of hands. Who uses stablecoin this week? No, not many people. Who's been using it? So of the 3 people that put their hand up, how many people, okay, I'll ask a different question. How many people use stablecoins for a business transaction this week? 2, 3. 4. Okay, 4. We got 4 people. And I think this sort of highlights where stablecoins are hopefully going, and we've got a lot of room to get to where we need to be. And so, I'm Chris Mihos, co-founder and CEO of makebanc. We're bringing off-chain asset managers on-chain in a compelling way. What I'll ask is everyone just does a 1 sentence about what you do, just to introduce the panel from the different directions that we're coming through. So Mushtaq, you first.
Sure. I run a trade association of Asia Pacific. We represent traders, investors, issuers in the bond markets with a focus on industry standards and regulation.
Brian?
I'm Mehler, CEO of Stable. We're a layer 1 blockchain that's focused on payments. With that, we use USDT as our native gas to improve speed and transaction finality.
YZ?
I'm building UR. UR is a Swiss-regulated neobank that brings both the crypto world and the traditional finance world together, issuing retail and corporate users personal IBANs, cards, and all that you can think of between stablecoins and the rest of the DeFi world.
Hi, good afternoon, everyone. My name is Shawn. I'm the VP of Asia for Hypernative. Hypernative is the security layer for all blockchains, any institutions that are deploying assets or operating on the blockchain itself. So we service more than 300 plus different types of institutions. That includes some of the largest stablecoin issuers like Circle and also stablecoin blockchains, the likes of Circle's Arc, Tempo, so on and so forth, where we do the security, risk monitoring, and also trade analysis for them, and also fraud prevention. Yep.
Great.
Hi everyone, Niki, Ariyasinghe. I lead Chainlink's business in APAC in the Middle East. Chainlink brings data that's off-chain, on-chain. We enable on-chain interoperability between public and private networks, and we connect the on-chain world with off-chain systems as well, both in TradFi and in DeFi.
Perfect. All right, so we've got a nicely balanced panel. Not too many that I think would be anti-stablecoins, so we'll try and weave that in a little bit to see if we can create a bit of spice. But I think there's $1.8 quadrillion that are processed globally through payments, and I think this is the foundational argument for where stablecoins fly. Now, just to kick things off, and I'll start with you, Brian. I just want to name one thing that exists today that won't in 3 years as a result of stablecoins. What is that going to be?
I would say if you're trying to look at what the future has in terms of stablecoins disrupting a market, I would be pressed to say that it would be corresponding banking. The reason for that is you have a very antiquated system costing billions of dollars to run, so that's the SWIFT network, and then also the intermediary banking. So the cost of that is already egregiously high, and that cost is getting passed down to the consumer in the end transaction, versus we've already seen stablecoins with the local jurisdictions approving regulations in Singapore, most recently in Hong Kong, and then with the Genius Act in the US and MiCA. You can actually disrupt that market by implementing a better layer at the base rather than trying to cobble something together that's already antiquated. So I think the question you'd have there, are the banks going to adopt current new systems, or are they going to try to ram something into a broken network? And I would say it's a low threshold to get it done, and I would imagine that the banks would look for that because they can retain more value while probably keeping the fees the same, and they just have higher profit margins on the top of that.
And do you think that we'll see some banks toppling over? As their whole value stream gets eroded, or how do you see it playing out?
I would obviously that's a reaction that the markets may have, but I would say that the banks aren't actually recouping all that money. I think the intermediary banks may be the ones to fall, but the end consumer banks or the retail banks will be fine because they're actually not clipping that much off the top of it. They can still charge those same fees. If they're getting out of a $45 wire fee, if they're keeping $5 to $10 of that, they can still charge that for the transaction as a $10 fee rather than a $45 fee. So I think they're going to just haircut everyone else, or the network fees, let's say, and keep that for themselves.
Yeah, makes sense. And I guess a lot of people lean on banks from an infrastructure stability perspective. And I think I'll pass it over to you, Niki, just to talk through, like from your perspective, what is that one thing that exists today that in 3 years from now might not exist as a result of stables?
Yeah, absolutely. I mean, just one comment on the earlier point as well. Like, I think our view is that ultimately the way the market will evolve is it's not just going to be one form of on-chain payment. So there's room for stablecoins, there's room for tokenized deposits, and also CBDCs when they potentially come back in vogue. And it's important to understand, like, there's a retail story here and there's a wholesale story here. And for example, when you consider the flows going through very large banks, then they're not necessarily going to be deploying those for stablecoins per se. They'll use something that they can control, more around tokenized deposits. So I think our view is that's the way it'll evolve. But to your question about what will change from a stablecoin perspective, to give a micro view, I think there's 2 use cases that stand out. One is the increasing use of stablecoins to subscribe and redeem into and out of on-chain funds. So the story has kind of started out with tokenized money market funds, but a lot of the subscription redemption flows are using current payment rails or using Swift and what have you. But at the end of the day, the value of organizations or retail consumers being able to subscribe and redeem into these types of on-chain funds is really more of a liquidity story and a seamless experience. And utility as well when you think about using those kinds of funds as collateral. So I think that's one area that will accelerate significantly. The other one, just to highlight as well, is that from a cross-border payments perspective, I think, and from banks, to my earlier point, they're going to separate into different kind of streams. And so one area that's typically ignored by large banks is cross-border flows for small to medium businesses. And I think that value of stablecoins for those small to medium businesses is already accruing. There's very, unofficially, let's say, in terms of some of the 2 leaders that are in the stablecoin world, there's significant usage of that, and that will really just accelerate significantly. So I think that will actually shift, but particularly for those types of markets.
And just going to jump into UIZ on this, I suppose, good little segue. Do you see this sort of shift into more white labeled banking, like account servicing as a service, having that account flexibility, or do you, I'd say not so much decentralized, but democratized way where that infrastructure can be connected into multiple different pathways, or do you see it that will almost mirror a TradFi world where there's a select number of banks that hold a lot of that power? Like, I suppose at UR, you guys are looking at providing a lot of those different account pathways. What's your bet on that? Like, where do you see this unfolding?
Yeah, for sure. I think as with a lot of the innovations that happened in the past within Web3, analogously, they followed how TradFi Web2 started working. So for example, in terms of creating banking as a service, relationships between B2Bs, that started a lot with the standard model of, even starting with like KYC process, there's a lot of KYC reliance. That's how a Web2 company would work with a PSP in fintech. And then they would just replicate this flow into Web3. But then you start to see that, and actually what UI is doing very differently here is because we are on-chain, so this layer that essentially allows you to exist everywhere as long as you're willing to connect your account, and it's regulated. So the model of you trying to go one-to-one relationship with a PSP and then to another, I think that's going to move away. So then you as a consumer, for example, will hold on to your, for example, on-chain money identity, and then just be able to go to all these different players, be it exchanges, wallets, connect such a concept, such an account, and then you can just use them quite permissionlessly, I would say, right?
Okay, yeah, so I suppose that ties into one aspect of like, what wins? The regulatory side or the rails? Like, I suppose it's the first time in history, one of the prominent times in history where there's like global rails, global opportunity, and this is sort of where I think anyone in crypto is drinking the Kool-Aid to say, like, the world is your oyster, everything's possible, but then whether it's banks feeling a lot of localized regulation and controlling factors to say, we want to have control, like, where does that fly on the continuum? And you see a lot of different regulators trying to gain more control, and from an institutional side, more aligned to regulatory friendly environment. So I guess from your take, Mushtaq, like where do you see that unfolding?
Yeah, sure. So I look at it, and our association looks at it mainly from the perspective of the wholesale securities markets. Right? But I also speak with a lot of regulators around the world, and I'm involved in some of the global regulatory stuff. Now, I think it's maybe slightly uncharitable to say they just want control. I think the regulators themselves would say that we are trying to protect the stability of the market overall, and also protect investors. So that's certainly what the regulators will be saying. So then the question becomes, what are the potential risks with stablecoins? Are there new risks? In some ways there aren't, right? If stablecoins are just operated under a new kind of global system, if it's another form of payment, for example, payment infrastructure, then I think the general view among regulators globally is let's just treat this as another payment infrastructure, and let's keep the same protections, the same disclosure requirements, the same responsibilities for anyone, whether it's SWIFT or correspondent banks, that they had in the past. I think some of the new risks, though, are related to the way that stablecoins are structured. So. Some of those are new, some of those are not necessarily new. So we have funds, we have redemption risk, we have liquidity risk, we have run risk, we have kind of downside risk in a crisis. Those will also exist for stablecoins. So a lot of the regulation that we're seeing now is how to protect investors from those types of problems and ensure, Europe is maybe a little extreme, redemption at par, but I think other regimes are more about having clear responsibilities, having clear disclosure about the actual rules of the game. Now, when you get to international cooperation, that's where actually the global infrastructure becomes really tricky. I think that the real problem that regulators are grappling with is how do you have accountability when things go wrong, right? If you have players operating in so many jurisdictions, if it's decentralized, if it's hard to pinpoint kind of who's operating and where, what my rights are in what jurisdiction, then regulators start getting really nervous because they can't cooperate with each other.
Yeah, and things can go famously wrong really quick.
Things fall through the cracks, right?
Well, I mean, it's almost like explosives are put into the cracks to make them bigger, right?
I think the market will exploit opportunities for regulatory arbitrage. Absolutely.
Well, regulatory arbitrage and then like hacks, right? So absolutely. I suppose as technology advances faster than regulatory bodies can catch up, regulatory, I suppose, guidelines have historically been more like KYC, AML, and Shawn, we were talking about this a little bit earlier of like how do you act in a protective capacity when, let's say, hypothetically North Korean hackers are going after your, I guess, let's touch on the hack side of things on two sides, but like there's the protocol hacks, but then there's also stablecoin hacks. Can you just sort of shed some light, Shawn, more on those types of risks? As if we're saying that it's the new layer for money, then there's a lot of risks that need to come to the fold for that. So, I mean, where do you see the future of these risks playing down or being played up?
Yeah, I think on the topic of regulated stablecoins, or even stablecoins that are right now issued within the crypto native space itself, that there is a requirement for a base layer of security, and I think that's where we have been working with a lot of the stablecoin issuers on that front to actually implement a very comprehensive real-time monitoring solutions to make sure their core contracts are not being targeted by the DPRKs of the world, right? State actors that want to do malicious activity. And on top of that, I think one critical part is also at the transaction level, right? So you've probably seen, I think, across the panel, we haven't really spoken about agentic payments, right? I think this is one of the key use cases that might be emerging out there with X402. I think there are a few players that are already kind of deploying this payment protocol on an agentic basis. How do you actually put guardrails around that, right? So we have seen internal fat fingers from some of the largest names out there where they minted 400 trillion stable coins, right? Those could have been prevented. So on top of that, if let's say you were to empower agents to actually do that, AI agents to do that, how do you build guardrails around that, right? So we are not only looking at prevention against state actors, but how can agents that turn rogue and put guardrails around that? So those are some of the topics that I've been working with some of the stablecoin issuers and payment financial institutions.
And do you think humans or agents who present less risk?
I think both presents equal amount of risk, in my opinion, because there is always the prone to human error, but for agents, we are probably seeing an increased level of intelligence, right? And I'm not too sure. This is my own personal opinion. If you look at, when Claude issued the newest Anthropic models, and we've seen a significant increase in number of hacks. The velocity of hacks and exploits have increased, right? The ability to vibe code and the ability to potentially create create attack vectors actually builds a case to actually put on more layers of defense, which I think this industry continues to invest more and need to be much more aware of the ability, to put in place institutional grade type of security, right? Where traditional teams would have huge number of threat detection teams, right? They invest into the Cloudflares, the CrowdStrikes of the world. We are building the same in the blockchain space itself.
Okay, yeah.
If I could be a little bit of a provocateur for the conversation.
Yes.
You guys at the beginning, how many people here have used stablecoins in the past week? And it was a very light showing of hands. I would maybe taking a different look at it. In the current market, or the current situation that we all exist in, could I get a show of hands of who here has had a credit card hacked or a bank account hacked? Probably like way higher. In the past few years, everyone's had like a credit card stolen or had to like get a fraud alert on their phone and stop a transaction. So if we're thinking of all the problems, if we are at the reflection point of like going forward with stablecoins, and everyone's thinking of possibilities of rogue agents and problems with stablecoins, what we haven't done is actually look back at the current system and how bad or underserving it is for consumers. So being from the US, we use something called ACH. And the wild thing about ACH is that if you have an account number and a routing number, the routing number is just your bank's address and it's public. And your account number is not a complication, doesn't have a check digit, it's very simple, and you can do something called direct debit, meaning that you take my account number and my routing number and you can pull funds out of my account without any sort of authorization. So I'm way less worried about an agent trying to get into a limited wallet that I allocate money to than leaving a paper check that's still pretty common in the US and having all the money drained from my account. So I would say bad actors, which are humans in that sense, because with what we do KYC and KYB is figuring out who those actors are, that intentional malice is actually way more costly than the hacks that we've seen in crypto, because there's billions and billions of dollars on a regular basis that take place all over the world because we have flawed systems. And again, speaking of the US, is tap to pay was the jump from magnetic stripes to tap to pay, because the hard chips wasn't really a major player in the US, and the credit card thefts was so high that you have higher transaction fees. So I'd say we have broken systems, and I find it slightly funny that everyone's very apprehensive about using a new technology that is fundamentally safer, just is trying to spitball ideas of like why this could be bad. So
yeah, I can comment on that a bit. Again, from the kind of traditional bond market perspective, I think the overall view, frankly, is that the technology probably reduces risk overall, right? Most of what was trying to solve, or what potential benefits of stablecoins, are reducing the fat fingers, but not just the operational risk, but also just the operational cost and all of the friction that's involved. The problem, though, is, and this is, I mean, I'm not saying it's a huge problem, but it's an obstacle, is actually changing the infrastructure from what was there before to what is happening now. And a lot of that is just driven, frankly, by investors. So looking at it, I'm not talking about retail, I'm talking about maybe more wholesale investors. If you ask your random bond investor, you're buying a bond, you call up somebody on a desk, you say, I want this bond. Back office just kind of takes care of it. It all works. Your assets are segregated. You're regulated. It's safe. You get your bond after 5 days. It's totally fine. What is the business case? And now maybe you're not even getting interest on your stablecoins, right? So
but to say, does it work, right? Like it's like, okay, we've now got 100 people that have been sweating over creating a prospectus and financial modeling, which is the weight of this stage. Yeah. Does that quantify it as working?
Yeah, exactly. So that's where I want to be a little bit more nuanced, is that I wouldn't say I'm not necessarily pro-stablecoin or anti-stablecoin. We're more pragmatic about it. So where is it actually creating value? Where is it actually reducing costs? And it's a bit more subtle. So I think in traditional bond markets, it's probably going to take longer because that system is just set in place. Most of the players are generally happy with it. But in areas where you need faster settlement, where you have a higher volume of more transactions, so especially like collateral markets, repo markets, interbank markets, cross-border markets where payments are very important and very difficult to do. This is actually where we're seeing a lot more traction in the normal banking industry. And I think there's some real movement there to use stable coins, and not just stable coins, but other forms of atomic settlement, atomic cash, right, for making greater efficiencies. But I think it's important to kind of distinguish where the use cases are and where the use cases are not.
And so jumping into, I guess, like more of a terminology layer, right, where I think the term stablecoin gets attached to lots of different things. So like, is a yield-bearing stablecoin a stablecoin?
I think regulatory definitions differ. Frankly, I should do my homework. But
I think one of the addictive traits of everybody in crypto is to go more and more and more technical and more complex, which adds more and more friction to wide scale adoption. And I suppose if we just touch on this, I guess Niki and Shawn, like I guess as we get into this, we're talking about stablecoins, so it affects all of us, but where do you think adoption will thrive the most from a stablecoin perspective? Is it on the yield side, or is it on the, let's say, transactional side, whereby it's safe and stable? I don't know, like, are you seeing a trend, Niki, from the infrastructure side of where it lends in different directions? Are people trying to set up their own stablecoins, or are they trying to stabilize the infrastructure they already have?
I guess, look, so one comment about like just stablecoin proliferation, I personally think that it's going to continue to proliferate for the coming 3, 4, 5 years. We're going to have hundreds and hundreds and hundreds of stablecoins launched by various projects, by corporates, across currencies, et cetera, and then there's going to be consolidation because ultimately the economics will bring everyone back down to earth a little bit. In terms of yield-bearing versus, is it just a more efficient rail? I actually think what will win out is the efficiency of the rail itself. The reason being, if you're talking about yield generation, as more and more assets come on chain, the level of competition for that yield is going to increase exponentially. So tokenized money market funds are just the tip of the iceberg. There's so much more coming on chain. So what investors or even retail consumers are going to have in not too far away, 1-2 years time, is a plethora of opportunities to generate yield for cash. It may not necessarily require a stable coin. But I think the payment rail component and that connectivity into to enable payment for some form of service or asset purchase, that's really where the core value will win out, I think, in the medium to long term.
And we've seen recently a lot of hacks that have hit the spotlight more on the yield-bearing side, which I think casts a bit of doubt or shadow into the stablecoin side of things. But where do you see, like maybe Shawn, just like looking at some of these different hacks, and I think it's sort of the headlines of drift, resolve, it's sort of, do you, and maybe in the stables bit here, but like, where do we draw the line between the centralized and decentralized aspect of protecting the currency with some of these hacks? And then where do we draw the line on like constructing yield and tethering them to the stablecoin piece?
Yeah, I think I will kind of distinguish them quite differently. So essentially, regulated stablecoins, you're not supposed to give any yield, right? I think that's the clear line right now, especially the most prominent Genius Act on that front. So from that perspective, the yield-bearing stablecoins presents a very different opportunity from a more crypto-native standpoint. And even from the yield generation standpoint, it's essentially a wrap asset management product in some sense, right? So it's not really a stablecoin in the most stricter sense. But in terms of comments on the recent risk and the security incidents, I think it only accentuates the need for, across the industry, whether you're an asset issuer, regulated or not regulated, it's about putting in place very stringent, controls to safeguard your users' assets, right? And I think I'm quite sure a lot of the asset issuers do put that as a baseline, but the idea here is really to level up, especially when, AI state actors continue to be trying to penetrate you. And I think that's the baseline that I'll make from a comment standpoint.
Yeah. Quick one. One currency or multiple currencies? So, I mean, at the moment, it's predominantly, and I'll lean on you, YZ, with this, but at the moment, it's USDC, USDT predominantly, and I guess in a TradFi world, it's also heavily US dollar denominated. But where do you see currencies evolving? When you're looking at it from an accounts perspective, are people looking for multi-currency stablecoin accounts? And where do you see that going?
I will look at this from two perspectives. So one, leaning on the previous conversation around trust and just adoption in general, friction compared to traditional finance. Definitely then the more branded stablecoins, USDC, USDT, these are definitely based on our just data, transaction volume wise, 99% of the users use these, right? We support other stablecoins, but generally people just trust these because it's been around for long. There's just a lot of traction, a lot of regulator approval in that sense. But then there is also another perspective, I think, from a corporate treasury point of view that we are starting to see. Speaking to partners, companies, where wanting to use I would say custom branded stablecoin for their own treasury flows, especially for bigger companies. I think SpaceX was a good example, working with Bridge previously to create a stablecoin for them to manage supplier payments, treasury management. That gives them a lot of capital efficiency, gives them a lot of ability to do settlement a lot faster, versus like what Brian said, having to rely on Swift or even ACH and things like that. So the latter part, treasury and corporate use cases, I think it's to be seen, but I think that could be potentially a very huge driver if we were to go past the initial hurdle of trust, right? And I think the trust portion, the biggest difference is that this is like a ground-up approach, right? We have so many builders trying to build stable coins and projects around it. I think that is also that is a pro to pushing adoption, but also a con because it creates a lot of active factors. So I would say hopefully moving forward, that gives us a lot of proliferation for more multi-currency stablecoin. I think that would be, in my opinion, the ideal case.
Yeah, can I quickly ask everybody in the audience, who would be comfortable being paid in stables? Show of hands. Yeah, it's an interesting one, right? As far as, because it's that cross-section or intersection of business banking, retail banking, and where it becomes that, the currency of value. And as far as adoption.
So I think one nuance that we found, because we work a lot more with the retail users, the fact is that they don't care, right? They just want their money in their pocket.
Okay.
And so why I mentioned a lot about the corporate use cases or even cross-border remittances, because there's this thing called orchestration or stablecoin sandwich, right? Which basically just stablecoin in between countries, and then you move it to the local payment rail. To the user, you receive it in your bank account, great. But then the main use case here, the main proliferation is still between corridors. And I think that's where a lot of the B2B use cases would thrive. And so that's why I think the show of hands would kind of tell that picture, because they wouldn't care that they would receive in USDC because they probably don't know. I think that would be at least the observation in past year. Yeah.
I would say, from our perspective, we run a global team. It's been fun to kind of understand the different nuances where our team members live. But one of the things is you have to manage payroll. And so, I'm a big proponent, in-house of our company, of eating your own dog food, understanding how it works. So we now started paying some of our team in their stable coins. Cross-border is just easier because you have your contract. You want to make sure you're paid in real time. But the problem with that is we have teams in Korea, Australia, in Europe, and one of those things is that there's different holidays constantly. So what it really struggles, like, I can make those payments, I know when they're going to be there, they have the confirmation it's there, rather than, they need to upload a new KYC form. Instead, it's I'm done with the transaction. It's now in their hands. So it's been nice. Also, staying in our own lane is we have a lot of vendors in the space. So I would say predominantly probably like 75% of our vendor charges, whether it's like RPC nodes or some like KYC providers, are all taking stables. So that's really easy. The annoying thing for me is that when they submit an invoice, let's say on a Saturday, my time, but it's still Friday in the US, I still have to make the payment on Saturday. So it allows for that real transaction speed. And I would say like the difference is there's less of a follow-up. So they send the invoice, the message gets sent and it's done, rather than the back and forth of, send me a copy of the SWIFT advice or something like that. It's just done and it's final. So that's been a nice shift in how people are using it. But in terms of single or multiple stablecoins to answer, or currencies to answer your question, I would say the settlement layer, the US dollar still has that majority share, as you mentioned, the 85%. And I would say that's going to be hard race to fight, but I definitely think in the local currencies, that's going to, based on jurisdiction regulations, it's going to take off. And I would say you even have things like Kakao in South Korea, where they're building a super app, and they have a closed loop system where they have the currency native to their app and it's locked in. I think that's a strong use case again. So deeper the moat for those, the more niche you get, the deeper the moat, the longer it'll survive. So you're really only competing locally rather than have to worry about globally. And then as you're talking about like doing the swaps and the FX, that's where you then go in and out of things smoothly and across borders.
Yeah. Niki?
Yeah, I think it's important, like taking a step back, right? Like when you think about why stablecoins were invented, they're originally invented purely for crypto to hold stable value in and out of crypto assets. But what we're talking about, in essence, is evolution to the payment rail story. So in that context, our view is there will be multi-currencies. It's not all currencies. I think there is going to be a lot of pressure being put on, say, smaller countries or countries with weak currencies, where that will actually put a lot of pressure on their banking systems. But importantly, like in terms of how this is evolving, we think that there was going to be a demand for multi-currency stablecoins. But also, when you think about how some of these financial transactions and workflows are being redesigned, it actually goes in multiple ways. So if you assume that you don't necessarily need a USD bridge and you can go direct to another currency, organizations are looking at, and not necessarily to cut out the US dollar, but just to cut out a middleman that is using a bridge currency. And if you can go direct, organizations are now looking at, well, can I go direct? And that creates demand for those particular currency pairs and demand for those particular currency stablecoins. I think also from a Hong Kong perspective, and a question that was asked of me actually at Hong Kong FinTech Week last year was, do you think there's demand for a Hong Kong dollar stablecoin? And obviously we're heading in that direction, but my answer was absolutely yes, because the important part to think about is whether it's a stablecoin or tokenized deposits or CBDCs. If you zoom out, the Hong Kong dollar is the 8th most traded currency in the world. Right? So that ultimately is the target market. And as more of these payment instruments come on chain, that's the direction it's going to head into. So we're firmly of the view that it's going to be multi-currency.
Yeah, I'll just add one last comment there. In engagement with central banks and regulators, especially in a very, I would say, fragmented world, I think geopolitical risk and taking specific defensive positions against the dollar has been huge on a lot of this regulators and central banks' mind. So there are certain countries that have very implemented tight capital controls. So having the proliferation of permissionless stablecoins doesn't fly with some of the central banks there, right? So the idea of having digital money in local currency, whether it's stablecoins, tokenized deposits, or CBBTCs, all right, those are in the works. So I wouldn't say just a single currency for now.
Yeah, interesting. So we've got 5 minutes left. I'm going to try and be a good moderator and stay on time. What's something, I was going to say 12 months, but let's shift it out because I think there's a bit of adoption that's going to take place. So what's something that we will learn over the next 3 years that we wish we knew today? And just to age this panel appropriately, and I'll work our way through just as something to finish off. I suppose I'll eat my own dog food and ask the question to myself first. I just think we'll learn over the next 3 years that friction will disappear. And I think that includes tech friction, it includes regulatory friction. I think the advancements that we'll have with AI will abstract away that complexity that we've almost been addicted to in a TradFi construct and a crypto construct. And I think 3 years from now, we'll look back and say, I wish I knew that that was going to disappear rather than something to lean in on. That's mine, but work your way through to put you on the spot. Unless anybody else wants to go first.
It's a good question. I like it. I think I'm kind of showing my age, but I think I've been around too long and lived through a few financial crises. And I'm worried about the unknown unknowns, right? Crises are never predicted far in advance, right? We're never kind of know what's going on. And I'm not saying that something will go wrong, but I'm saying that there are significant tail risks here, right? I mean, one obvious one is just U.S. treasuries, right? U.S. securities. Stablecoins are backed by U.S. Government-backed securities, and those up until now have been unimpeachable, have been AAA, have been fine. But if there is a kind of chain reaction of
then things can go south pretty quick.
Things can go south pretty quickly, and that's not necessarily under control of all of us on the table, right?
Sure.
It could be a combination of cyber, of hacking, of geopolitics,
Yeah.
of just bad economic conditions and so forth. So I'm not saying that will happen, but I do feel that maybe not enough attention is being paid to some of those very, very tail risks and how they're going to be managed if something goes wrong.
Sure. I would say, like, looking back, you're going to realize like how underserved or how terrible the current systems are in terms of like moving, accessing, engaging with money, investing, that it's one of those things like now people use like Venmo or like a peer-to-peer payment app, and you're like, wow, this is great. But if you really think back, it's only 8-10 years ago where you were like writing people a check or like giving people cash, and how terrible that was. But you just did it because that was the commonality of the life back then. So now we look back, if someone asks you to like pay for cash for something, everyone kind of like whinges a little bit because you don't want to do it. Instead you're like, can I just Venmo you? Can I just bank transfer you? So I think we're gonna have that same reflection 3 years from now, be like, oh, this was really bad. Like that was a terrible process. So I think that's the change.
Like a week to open an account versus a minute. We'll just be like, you used to do that?
Yeah.
Okay.
Yeah. The notion that payment, you start with local, right? Payment is always about local, regional. I think we're moving towards a global payment ecosystem. So, of course, with UR, that's what we're striving to do. Everywhere you go with just one identity, we connect to all the regulators. Obviously, we try to understand all the nuances and the risk appetite of different countries. But ideally, from a retail and corporate perspective, that's where you can be. You don't have to worry about, oh, can I just pay in this currency? It should be global with your identity tagged to something that lives with you, which is your money.
Yeah.
Yeah, I think 3 years from now, I feel like a lot of the underlying rails are replaced, but you don't feel any change, right? I think that's the beauty of where we are right now with AI and also the adoption of blockchain rails. I think that transition will feel like behind the scenes, but in the surface level, you realize there's no change.
So akin to not getting into the deeper infrastructure of how the internet works, you just use it.
Yep.
Okay.
I think in 3 years' time, we're going to look back and think that we should have understood the importance of wallets much more and how they are going to become the interface, the consumer interface for on-chain transactions. Right now, they're just an underlying infrastructure, but I think their importance is underappreciated.
Wow, we've got 25 seconds left. We're good. Are we doing questions? Are we not? Jordan, do we do questions? Does anybody have a question? Yeah.
Circle was working on.
So the question is, what do you think of reversible stablecoin payments? Who wants to take this one?
So I would say, like, looking at the current ecosystem right now, I think adding that variable would be a complication that would hinder the overall adoption. I think right now when you transmit with cash, or you go to a store, you pay cash, you can't take it back. Same thing if something settles on the other side of a transfer, you can't just go take it back. So I think that's a nice topic a novel idea to look at in the future, but how you implement it and how you implement it globally is going to be something that needs to be understood a little bit better. So I would say don't jump into it just because it doesn't currently exist. So let's not make it a complication right now.
And I'll just put a plug in here for Hypernative because we're looking to work with them. Rather than post-transaction regret, have pre-transaction simulation. So it's sort of early detection is the best prevention. I mean, that's a medical kind of pathway, but maybe that's a similar pathway for transactions. So before something goes wrong that you would want to reverse it, make sure you know what you're getting into. And that goes beyond just the risk of like a hacker taking it, but into also, are you sure you want to be making this payment?
Sorry.
Escrow.
Yep. To jump in, that's the whole idea of like blockchain originally was like programmable like actions and activities. It kind of has lost a little bit of its purpose lately, but that's the whole intent, is that you would have an escrow account where you send it in when they provide whatever asset there is, and that would use like a real world, like RPC or something like that, a real world oracle to tell you like the transaction on their side's done. It really is borrowing a page from PayPal and eBay, 15, 20 years ago of how you did transactions. You put in the transit number for you're shipping something. Once it showed it was delivered by USPS, the money was then released. So that has already existed for hundreds of years. We just need to actually use it now to make those transactions, as you're saying. So not reversible, but programmatic.
All right, that's it. Thank you very much, everyone.
Thanks for having me.